Hello. Today I want to talk about NVIDIA. The title is Textbook Opportunity. I usually use Gamma to create a PPTs, but Gamma is not good at creating images, which includes alphabets, so excuse me. Anyway, let's get started. This is key metric at a glance. Actually, I wrote the report on Sunday, but today is Tuesday, so price is now in 230, rose of like 10%, which is impressive. Anyway, executive summary. After NVIDIA's fiscal year 2027 first quarter earnings release, NVIDIA has undergone correction, declining approximately 10.7% from its recent peak of 236.54 to the price of 211.14. This pullback largely prices in anxieties over a potential peak out in AI infrastructure spending, alongside fears of a liquidity drain triggered by mega cap tech IPOs such as SpaceX. And also, there is lingering geopolitical concern surrounding China. However, my report views the current consolidation as an optimal entry point. Below is a quick view of the why, and I want to tell you about each of these. First catalyst is overwhelming earnings. First quarter revenue reached $81.62 billion, comfortably beating market consensus. What directly dismantled the market's peak out skepticism was the upward revision of next quarter revenue guidance to $91 billion. As the supply chain visibility for the Blackwell platform materializes, it has been reaffirmed that hardware demand from hyperscalers forms a robust order backlog extending through at least 2027. Catalyst number two, capital returns to shareholders. The newly announced $80 billion share buyback program will meaningfully reduce shares, driving shareholder value upward. And also, the increase of quarterly dividend to $0.25 per share signals a paradigm shift from a pure high growth tech stock to a cash generating company with enormous free cash flow capabilities. I think maybe this is the most important part, the TAM expansion. Any potential stagnation in hyperscale revenue will be fully offset by the rapid opening of new addressable markets, sovereign AI and physical AI. Sovereign AI is about a national security and survival race where governments build independent infrastructure to secure digital sovereignty. These state driven projects boast highly sustainable budgets, and given their lack of in house chip design capabilities, they must purchase NVIDIA's full stack solutions turnkey. For example, Chief Executive Jensen Huang is scheduled to visit South Korea on June 5th. And given the South Korean government's strong commitment to constructing an independent sovereign AI system, this issue is highly expected to be a primary agenda for the upcoming meetings. Physical AI represents the evolution of artificial intelligence into the physical realm, the real world. Uh, and physical AI encompasses robotics and autonomous driving, like what Tesla does, and smart factories or something. Requiring real-time physics calculations and NVIDIA's Omniverse simulation ecosystem, this paradigm shift would drive additional demand for the NVIDIA's chipsets. Jensen Huang's planned meetings with major South Korean companies, including Hyundai and LG, is literally example of this. Expanding market opportunity. And of course, I have to deal with some risks. Risk number one, hyperscalers in-house AI chip internalization. This is concerns about chip developments by core clients such as Google, Meta, and Microsoft or something. Market worries that these will cannibalize NVIDIA's data center revenue. But in my opinion, this is an exaggerated concern, stemming from viewing semiconductors as simple commodities, which is not. NVIDIA has maximized industry-wide switching cost through its proprietary CUDA software ecosystem. Additionally, by combining high-speed networking acceleration via InfiniBand, NVIDIA provides comprehensive supercomputing systems rather than just isolated chips. And also, revenue from non-hyperscaler customers, which are incapable of custom chip design capabilities, has expanded to roughly 40%, which is quite a lot. This shows NVIDIA is successfully diversifying the concentration risk away from hyperscalers. Risk number two, China and geopolitical issues. The earnings impairment caused by export restrictions, which made revenues from China close to zero, has been prolonged and is already priced in, I think. And also, dependency on TSMC creates permanent geopolitical discounts. This problem could gradually ease via US foundry diversification and advanced packaging ecosystem pluralization. But I have to admit this, these issues are still very challenging. And I have one thing that I must point out. Anticipated IPOs of mega-scale companies like SpaceX, OpenAI, and Anthropic in the rest of the year 2026. This could serve as a liquidity drain for the market level. Institutional investors will likely harvest profits from NVIDIA to balance passive portfolios and secure cash for public offerings. This will create a short-term pullback driven purely by fund flows, independent of company fundamentals. The point is, independent of company fundamentals. This is literally nothing to do with fundamentals. So if price goes down because of IPO issues, it would be a great chance to expand your position. Well, if your position is long. Valuation and target price. NVIDIA currently trades at a 12-month forward PE ratio of 23.61. This sits below Apple, which trades at a 28 or 30 or something. And this is point. Apple shows single-digit growth, while NVIDIA shows two-digit growth, which means that NVIDIA is much more growing. And considering that NVIDIA has historically traded at a 5-year average multiple of 40, the current level reflects an excessive discount, even when factoring in earnings normalization. Reflecting the fiscal year 2027 growth rate of 87.48, which is terrific, the stock's PEG ratio compresses to 0.27. 0.27. Can you believe this? Anyway, NVIDIA is now in a severe valuation undershoot. And when substituting the fiscal year 2028 normalized growth rate of 41.54, the PEG ratio stands at a 0.4. Even when based on 5-year estimates, the PEG ratio remains at 0.65. Actually, I don't want to talk about information about 5 years later because we cannot know that. But one fact is obvious. All the numbers I mentioned are falling far short of 1.00. And, 1.00 is considered as fair value. Therefore, applying a target PE of 30 remains very conservative, I think. My target price is 12-month EPS multiplied by 30, which is 270. This offers a compelling margin of safety while fully accounting for any earning normalization. This is the end of today's video, and you guys can check out my report, my whole report, through the link of the description. That's all, and thanks for watching. Bye bye.